Alright, welcome back. You're watching First Trades live on ET now. Let me now bring on board Kulbir Madan, founder and managing director of Brahma Investments or Brahma Management. Kulbir, good to have you back on ET now. Thank you for joining us. At the outset, first, congratulations. I've been told that Brahma India, the fund you manage, this year globally has been rated as one of the top performing funds. And your fund is up by about 18% in dollar terms. That's a smart appreciation. How did you manage it? How did you differentiate?
Well, thank you, Nikunj. Thank you, Aisha. It's been a very, very tough ride. It's one of the toughest markets that I have encompassed, and I've been running money for about 20 years. And a lot of fund managers have tended to make a lot of mistakes in this market. So one has to be very diligent of knowing where where India places itself, along with the European and the American crisis that is going on. So as I look at it, and I've been talking about it for the last 6-8 months, this is a market going nowhere. So we have to become very stock specific, which happens to be our strength. So we have tended to perform well, but we keep our exposure very low. We are very nimble, but I don't think these markets are going anywhere anytime soon.
Gulbir, nonetheless, do you think 5,000 is a secure base for the index right now, or do you think we could drift lower?
We easily can drift lower, but I'm not a great technician by saying the 5,000 is a great base or it's a great value. The whole problem is that when the crisis goes into the back burner and everything gets discounted, the markets tend to rally. And when they come to the forefront, there's always some panic. I'll give you an example. I think this year's market, and it's led by the US and then Europe, and then we come down to all our emerging markets. It's an election-led rally, and I think we are coming to the end of the rally. I personally think that we have already discounted a positive election of the incumbents in the United States, and so I don't see that this market's going to break out anytime soon. I'll tell you something very interesting, and I think which will be very interesting for your viewers, would be that the S&P 500 for the last 12 years has gone nowhere. In June of 1999, the S&P 500 was at 1400, and it's at 1400 today. And in between, in these 12 years, it reached 1400 in 2006, it reached 1400 in 2008, and now it's hit 1400 again in summer of 2012. So in 12 years, which is a very, very long time, the markets have gone absolutely nowhere.
Well, the same story for India as well, because in 2008 index was at 21,000, we had 17,000. In 4 years we've not gone anywhere. So do you see a Dow S&P like scenario panning out for India as well, that for next 5 years we will go nowhere?
I do not know 5 years and 5,000 levels. I'm not God, and I can't predict those things. But yes, I do not expect a breakout. Can we decline? We most definitely can, and most probably we will. Whether it will happen from 5,400, where I think we are close to today, or whether it happens from a lower level, I will not know. I just think that this recovery has been the most anemic in the last century, and this recovery has been a jobless recovery, and people better not forget it. Jobs are the most important thing in any economy, and it's a problem globally. A few days ago, I read about Spain unemployment hitting 25%. Those are real numbers, and they really hurt. And so I don't see the world going anywhere soon. And the same thing is about India. I think the Indian story is all right. It's a demand-driven economy, and I think the biggest problem in India is the supply constraints. But I think that India will be fine, but it'll pretty much follow the path of the global masters, the United States and Europe. Europe is a problem.
Right. Gurpreet, just getting back to the point that you were making, considering the key triggers in the near term for global equities is whether or not they're going to see any liquidity easing from the Fed as well as the ECB, and that seems to be the only trigger in the queue that the markets are waiting out for. Can we expect a significant change in Fed's language from August 31st, and will they at all move on a QE3?
Absolutely not. And I don't think the world should expect anything dramatically different. We are already, all the governments have pumped so much liquidity into the system. That's why we are here. And you know what happens when you pump too much liquidity, you know, it finds a home in certain asset classes. And if you go back 10, 15 years, we saw it after Y2K, the liquidity when it found itself a home in technology names. And then after the 2000, when the bubble burst, and there was again a liquidity inflow, it went into the real estate market. So we are already flush with liquidity, no change in policies by any major standards. Everything will be the same. I think the whole thing, in the second half of this year, we should worry about is, or not worry about, to look at, is how the US presidential election comes out. If the incumbents win, I think we have a few more months left. It'll be fine, but if the incumbents lose, I think the markets could sell off quite heavily.
Right. You know, in 2006 when we were having a conversation, you were hot on Strides and you were hot on Eicher Motors. And if I look at the stock performance, Strides has been a 6-bagger, Eicher has been a 10-bagger. Do you still like those stocks?
Yes, I own them. Like Nikunj, you know me many years. We are not traders, we are investors. So if we get a great idea, and you've been very kind by only naming a couple of the good ones, I'm sure I have a few dogs in my portfolio too. But what it is what we try to do is we try to find segments and then companies in there which we think have got enormous growth potential in the next 5 years, 10 years. And if we can latch onto them, we end up with companies, and they were small companies then. Eicher Motor was a very tiny company. And Strides, you know, it's gone and achieved so much in this last few years. We have been thrilled. And some of the larger companies, like the markets in the last 4 or 5 years in India, have pretty much gone nowhere. The Nifty has gone nowhere. But you just have to be a stock picker in this market. And what I advise everybody is pick your sector, pick a good company, stay away from leverage. Leverage is a dirty word. And leverage is going to come to haunt everybody, I think, for decades to come. And sometimes leverage is good when there's a robust economy. But in a stalled economy or stalled global economy as we have it now, leverage is going to be bad. Even the emerging markets, I think one has to be a bit careful. I think they are the fastest growing still in the world, but I think one will have to be very, very nimble and very careful of how we're going to navigate this in the next few years. Well, I again want to tell everyone, I think this is a market to nowhere.
Market insiders who know you and who service you are telling me that you're hot on fertilizer stocks. Why do you like fertilizer companies of all the stocks? I think you have a holding in Chambal Fertilizers. I may be wrong, but you can defend it.
Yes, I own some. I think it's more a defensive play. We do own stocks. It's not like we don't own stocks. And you know, if we come to 5,400 level, it does not mean I pick up the phone and we sell everything in our portfolio. It doesn't work like that. We'll never have a multi-bagger in that case. Yes, I think it's a defensive play. I think we are relatively comfortable. But no, I don't think we expect very many multi-baggers out of the field either.
So how is your India portfolio structured? What are your key overweight positions? What are your key underweight positions? Which are the sectors you're betting on? Because you got a call on pharma, right? But at these levels, pharma, I guess, is priced to perfection.
You're so right, Nikunj. I think the pharma stocks, not just in India, globally, have had a huge run. And again, it's a defensive play also. So when there's asset allocation that goes on globally, pharma has got its share. But I think the autos will still have more to go. And there's so many segments in India. Anything that's consumer related, retail related, and they do not have leverage, and they have a true story behind it, I think it'll do exceedingly well. It'll do exceedingly well because the demand is tremendous in these parts of the world. I told you, we're all supply constrained. So it's not very difficult. The only thing I would advise anyone is please stay away from highly leveraged companies because you could have a pitfall in front of them.
So amongst global equities, Gulbir, since you think India is not going to go anywhere in terms of an equity market performance, where do you think are we going to see strength? Are there any emerging markets which you're hot on right now?
No. As a matter of fact, I think the emerging markets, the mystique behind emerging markets is waning. But that doesn't mean we are net shorted. I don't think one should be. They are still one of the fastest growing markets. But the global economy has pretty much stalled out. So we have very anemic growth globally. And I told you, globally, we have a problem with jobs. And I think that will also come to affect countries like India, but differently. Until that's not solved, and which I think can be a multi-year problem. Europe, I think, is a 10-year problem. So there will be phases within the decade when we will outperform and we will underperform at different times. But until we don't get our act together globally, I don't think this world's equity markets are going anywhere. Our interest rates are practically zero globally now. I mean, how much more liquidity? When someone asks me, will they pump more liquidity or do a QE 10? It's not going to make too much of a difference. We are where we are. So the only companies, we have to be able to pick stocks. If we can find a segment where the growth and the company and the balance sheet is not levered, I think if you can find a good one, I think we will make money. Because there is money flushing around in the world. Everyone is hungry for yield. Today, if you're a dividend-paying company, I mean, you are considered sexy in the world. But, you know, it comes with its own set of problems. Just because you pay a dividend doesn't mean a company is going to do exceedingly well. But these are themes that come around. They are trends in the world, but they'll keep changing. I think one has to be very defensive now. Yes, look for dividends. I think that's a good thing because we all yield hungry. In India, I think the bonds are well priced. You get a good yield for the risk. The currency, I think, has pretty much made its move in a country like India. I can't say for the next few percent. So I think we'll be okay, but one has to be a bit defensive. Just be intelligent, use your common sense, and I think you'll do exceedingly well.
Make life simple for our viewers. When you say be defensive, what looks interesting in the defensive space? Because defensive stocks are priced to perfection. HUL is something like 30 times, Nestle is 40 times, ITC is 25 times. What is cheap and attractive in the defensive theme?
Yes, you know, you're very right. I think you hit the nail right on the head. You can't pay any price for just because you have to be defensive. You know, you can also be in cash for a little while. It doesn't hurt you. The huge runs, the ITCs and Hindustan Levers, we just sold in the last 6 months all our ITC position and a Hindustan Lever because we thought they were priced to perfection. When I say defensive, just you have to be defensive in your portfolio. An average person doesn't have to be fully invested all the time, but perhaps like a mutual fund does. And in a mutual fund, they may have to do the strategy of going into these names, and probably because of that, these stocks are priced to perfection. And but you have to be very careful. You cannot buy things priced to perfection. You have to be a bit opportunistic in life. And if you find they're discounted or the value is good, then you buy them. So no, I would not suggest anyone buy any of these companies at these levels.
All right, Juno, appreciate your time and so good to have you back on ET Now, and certainly hope to see more of you going forward.
Thank you, Nikunj. Thank you, Aisha. Good to